You've probably heard this a million times. Don't invest with insurance companies. Their fees are insane. Well, today, we're going to pull back the curtain on that piece of advice and see if it's actually true, or if it might be costing you a secure retirement.
I mean, you've seen this exact quote, right? It's all over Reddit threads, it's in financial articles, it's short, it's punchy, and yeah, it sounds pretty convincing. It really taps into that fear we all have that we're going to get ripped off by a bunch of hidden fees.
But is it really the whole story? Not even close. And if you're serious about planning for your retirement, you have to understand the full picture. Because just ignoring certain financial tools could mean you're missing a key piece of your financial security.
So let's just tackle this insurance myth head on. Why is this advice so popular? And more importantly, what is it causing people to completely overlook?
I love this car dealership analogy. Think about it. Sure, some cars might be overpriced, but the dealership is also the only place you can get certain models, or specific warranties, or that financing deal. Saying all insurance products are bad is the same thing. It completely ignores unique benefits that you literally cannot get anywhere else. All right, let's talk about the elephant in the room, the fees. This is the biggest part of the myth, and for good reason. Nobody wants to see their hard-earned savings get eaten up by high costs. But let's break down how fees actually work, because you might be paying them in ways you don't even realize. Take a look at this number, over $400,000. That's what a pretty standard 1% annual advisor fee could cost you on a $500,000 portfolio over 30 years. It's a huge amount of money. The point is, fees are a part of investing, period. The real question isn't if you'll pay fees, but how you'll pay them. So this slide breaks down the two main ways it works. On the left, you've got a traditional advisor who charges that direct fee right out of your account. But on the right, with many insurance products, like a fixed annuity, the costs are built in. For example, the insurance company might earn 6% on its investments and guarantee you 5%. That 1% difference, the spread, well, that's how they make their profit. It's not an extra fee on top, it's just part of how the product is designed. And this right here is probably the most important point in the whole fee debate. You just can't compare the cost of a product that guarantees your principal and gives you lifetime income with one that's designed for aggressive growth and puts your money at risk in the market. They're built for completely different jobs. It's a total apples to oranges comparison. Okay, so moving beyond fees, let's talk about something that insurance companies can offer that investment firms simply can't, and that is legally binding contractual guarantees. This slide shows the exact problem that annuities were invented to solve: longevity risk. It sounds a little technical, but all it means is the risk of outliving your money. For so many retirees, this is the single biggest fear they have. An annuity is basically a contract designed to make sure that doesn't happen. And this simple three-step process is incredibly powerful. You're effectively transferring the risk of running out of money from your shoulders to the insurance companies. Once you sign that contract, they're legally on the hook to pay you for the rest of your life, no matter what. So, who actually needs a guarantee like this? Well, ask yourself, do you have a pension? Do you worry about your savings running out one day? Do you want a retirement paycheck that you know will show up like clockwork, no matter what the stock market is doing? If you answered yes to any of those, then a guarantee isn't just some nice feature, it's a solution to a huge problem. Now, these guarantees aren't the only unique thing on the table. Insurance companies also offer some really powerful, low-risk ways to grow your money that a lot of people just aren't familiar with. Right now, you can find products called multi-year guaranteed annuities, or MYGAs for short, that are offering rates in the 5 to 6% range. The easiest way to think about an MYGA is that it's kind of like a CD from an insurance company. You get a fixed, guaranteed interest rate for a certain number of years with absolutely zero exposure to the stock market. And when you see them side by side like this, the key difference really jumps out at you. It's the tax treatment. See, with a bank CD, you have to pay taxes on the interest you earn every single year. But with an MYGA, your interest grows tax deferred. That means your money and the interest it's earning gets to compound faster because you're not losing a chunk of it to taxes each year. Over time, that can make a huge difference. This kind of product is really perfect for the safe money part of your portfolio. You know, that money you can't afford to lose. If you prioritize safety and predictability for a chunk of your savings, but you still want to earn a competitive interest rate without any of the stock market drama, this is definitely an option worth looking at. So the crucial point here is that this is not an either-or decision. It is not about insurance versus investing. It's about understanding what tools are right for your specific situation and your personal goals.
So if your goals sound something like this, I need to create my own pension, or I absolutely have to protect my savings from a market crash, or I need more tax-deferred growth, well then an annuity could be a really powerful tool for you to consider. On the other hand, if you have decades to go into retirement and you're comfortable with the ups and downs of the stock market because you're chasing higher growth, a traditional investment portfolio might be all you need right now. It really all comes down to your personal timeline and how comfortable you are with risk. The truth is, both wealth management and insurance products have a role to play in a solid financial plan. They solve different problems. The key is to stop listening to those blanket statements online and start comparing actual solutions based on what you are trying to accomplish.
The key is to move from these broad myths to your own specific goals. If you'd like to see a personalized comparison of how an annuity might fit into your retirement plan, our team here at the Annuity Expert can help you with that. Our services are always free. You can reach us at the number on your screen or visit our website. The most important thing is to make an informed decision for yourself, not one based on a catchy headline you read online.